strong chance of us heading towards a recession. So hang on to your cash so you can be buying when the property prices bottom out completely. No, hang on a minute. Isn't this what people were saying at the beginning of COVID 2 years ago? Look, at the end of the day, people did say that at the beginning of COVID because there was strong chances we was going into recession, and we did go into recession at the beginning of COVID. But the reality is nobody knows how the market's going to play out. So nobody can time the markets fully. And if you took that advice back in the start of COVID, you would have missed out on some phenomenal growth over the last few years. Listen, I'm not trying to say to you, we're going to carry on having that same sort of growth over the next few years, but it always is the time to buy property if you buy property correctly. So we're going to discuss that, but this is now the May market update. And in this market update, what we're going to be going over is interest rates and inflation. The house price growth, is it slowing or not? The big word recession and stagflation and that 18-year property cycle. There's been a massive shift in ground rents. We're going to be covering that, and we will be covering no money down property investing using crypto as your collateral. And at the end, we'll wrap it up with what my predictions are on the market and some of the things I believe you should be doing and can be doing right now to be able to stay in the property game. But the first thing you can do right now to stay into that property game is smash that like button and watch it give you a little reward of confetti springing up in the air. So yes, undeniably, there are a lot of signs that we're heading towards a recession. I'm not going to go too deep into what them signs are. You can watch this video on the 6 signs we could be heading towards a recession and basically come up with your own educated decision on whether we're going there or not. But as I said, and as I say in that video, nobody knows for certain when this will happen and how it happened. We all know for certain we will have corrections in the market. So what you have to do is position yourself correctly to be able to ride out their market conditions. One of the main reasons, there's a lot of talk around recession at the moment. Some people even saying, like, if you follow Grant Cardone, he's even actually saying that we are in a recession at the moment. And the reason that I've got lots of talk around this is inflation and the interest rates being risen so quickly to be able to try and curb that. So Bank of England raised interest rates again 4 times on a trot. So this has taken interest rates from the lowest in history to higher than it's been in over a decade. So just a few months as well. So this is really, really interesting times, and this is the big worry around the recession that might be coming. There's a really interesting article in The Guardian, and it says what the Bank of England base rate means in numbers. And if you go through this, it says that the Bank of England has increased the base rate to 1% in an attempt to curb inflation. It's the 4th increase since the start of December, when the base rate was at 0.1%. Here in numbers is what it would have meant for your finances. So again, read through this article, and in 2009, last time the bank base rate was 1%, it was cut from 1.5% to 1% in February that year of 2009. So if you have a look at these charts, and it shows you where we've dropped down and where we've been, and half on the bottom we've been for a long while. So 7% inflation is where we've been, and at the moment they've not factored in April's, as at time of recording this, April's inflationary levels have not been factored in with the fuel rises, 54% rise in energy costs. So it's going to be even higher than 7%. They are predicting as well it could be hitting 10% at the end of the year, causing a lot of fears. And the pound plummeted as a result of this, lowest it's been in over 2 years since we went into that recession, that mini dip of a recession from COVID. The current rate of inflation is 7%. The Bank of England's job is to hit 2% inflation targets. 1,092,000 is the number of people on a variable rate. And the difference in the variable rate, if you've got borrowing of around 200,000, that is going to be £504 per month's difference. 4.17% is the average variable rate for people that's going to be on this new base rate. So there's interesting stats across this Guardian article, and this is the fears around why we're going to hit to a recession. But there's a lot of talk around stagflation. So what is stagflation? Stagflation is basically a recession when you still got inflationary pressures going on in the market. So if you look at the house price growth and the housing market at the moment, it's not showing signs of easing up. In fact, it sped up again in February and March a little bit, showing that there was 26 home buyers to every property that went onto the market. We've still got a massive supply and demand issue going on, but there's two supply and demand issues that we've had that's been pushing the prices up on the properties. The supply and demand issues we've had is, number one, there's a low stock of inventory of properties. We've not been building enough properties for the last 30 years, and we've also not had enough properties on the market since COVID, because lots of things sold off when we went into lockdown, and it's never recovered since, and especially with all the stimuluses. Last month has been showing stronger signs again with demand since they released the stamp duty holiday, which was one of the fuels to this fire of massive house growth. And the reason why there's so much talk around stagflation is because we're getting this growth still in certain areas. And the reason we've got so much growth is because so much money got printed and forced into the economy, meaning people will spend more. Interest rates really low, loads of money and availability to lending. So the second part of the supply and demand is availability to access to or funds and funding this stuff. So we've had lots of access. The banks have been pushed out there to lend. But a bigger picture thing you've got to look at on house price growth as well, in my opinion, and these are only opinions, by the way, nobody can predict this bang on. We can only look at the data and gather our own opinions. But you look, banks have been stress testing people at around 6-7% on their affordability. So if a lot of people can afford this rise, maybe not 6-7% with all the other inflation that's going on in the economy, but banks have been lending very, very responsibly at the moment anyway. And then banks are looking like, at the moment, they're relaxing the stress test that they're doing on your affordability anyway. So if the base rate goes up and the relaxation of the stress testing comes down the other way, this probably would not have a major impact on lending in the market. I feel some banks will pull products. I feel it have a much more heavier psychological effect on people worrying what's going to happen. I feel it could have an effect like this, where people will go, okay, I'm locked into a good interest rate. Do I really want to sell my house now and go into a worse interest rate? I might as well ride this out and see where we are. So it could slow up the supply, the amount of properties that come into the market, and stop people putting properties back on the market, which will carry on that pressure going upwards if there's not enough stock, because there is a certain amount of people that still want to and need to move homes. So the Guardian printed this, issued this, they don't print anymore, do they? But the Guardian issued this online article saying stagflation looks a race uncertainty was worse to come from the UK households. And basically it's saying, look, inflation in March rose 7%, but April's figures will include 54% increase in energy prices. And of course, we've still got the Ukraine and Russia conflict going on, which is forcing inflation up even higher. So the worries of stagflation is a big threat at the moment, because there's low stocks and there's reasons pushing house prices and a lot of other inflationary things upwards. But also economy is getting slowed down and there's things that are forcing it downwards. And there's lots of comparables being drawn to the 1970s stagflation period, when we had this oil prices going through the roofs, cost of living going through the roof. So a lot of comparisons. Some are trying to play it down, some are comparing that. But when we look at the 18-year property cycle, Fred Harris still is saying that 2026, pretty much the founder of the 18-year property cycle, the methodology behind it, he's saying 2026 is the time when we're going to hit our correction in the property market. So just because we hit a recession does not mean we're going to hit a correction in the property market, and vice versa. Sometimes property markets might correct a little bit. It doesn't mean we're in a recession. Is it the GDP and the economy as a whole? So in this article from Money Week, it's talking about Fred Harrison, and he is saying prices will peak in 2026, as we just said, but the UK prices will fall, but not for a few years. A lot of people are predicting a slowdown of prices. I was watching an article with the Zoopla CEO, and he's saying the same thing. You can see it slowing a little bit, but still there is upward pressures on the market for the supply and demand. There is still a supply of money still coming to the market. Will banks tighten up on that time will only tell on that. But look, why there is supply in the market of money, the banks are sitting in quite a strong position because they're not over leveraged. It's very different to the '07 crash when they was over leveraged, overstretched, banks was failing, governments were bailing them out. They're in a strong position because they're lent very responsible at the moment. So they've looked at people's affordability. So it's a very, very different place to the '07 crash. If we do slip into a recession, we slipped into recession in 2020 for a short period of time when we went into the COVID. And again, every recession, any correction is got different reasons behind why we correct, which has different effects on different markets. But as I said, time in the market is always going to beat time in the market. We're never going to beat that time. It's exactly, wait to stay on to the end so we can go over what you can be doing to stay time into the market. But this leads us into ground rent and the reform of ground rent. The government have been talking about a reform of the ground rent. And quite honestly, I thought it was just a vote winning thing they was talking about. I extended one of my leases, and I did ask the lawyer at the time, what do you think? Do you think I should hang out to see what happens with this? And they was like, no, just go through with it. I'm guessing they just wanted their wages. That's maybe me being cynical. I hope they didn't say it for that reason. But I spoke to a few people and they said, look, I wouldn't wait around for anything with this. And the government are renowned for saying, we're going to build 300,000 properties next year, and don't deliver on that. Renowned for saying things like this all the time, but not delivering on it, and especially when it's around voting time. But they have delivered on this. So from 30th of June 2022, ground rent will be zero. There's an article here in Property Reporter, ground rent charges to be banned on new residential leases. So as far as I'm reading, if I'm reading this correctly, this means any person extending a lease or anybody buying a new property will be issued a new lease, and they've got to be classed at zero going forward. So this may be a time for you to rethink about re-extending your lease. I'm going to speak to some lawyers. I re-extended mine not so long ago, but I'm going to speak to some lawyers to see if I can re-extend it again to the full amount, because I think we got a certain amount of years, and I think I can up it to 990 years, just a little bit more than where I'm at the moment, and then it will give me zero ground rent going forward. And because I've already got a long lease on it, the cost of extending that just that slightly bit further shouldn't be much money. The cost of a lease is linked to how low the lease is. So the lease is really low, you pay a lot of money to extend the lease. As far as I understand, I'm not sure because I've extended mine, this is stuff I have to dig into, but as far as I understand, they've not got a choice. If you want to extend it, you can just issue them with notice saying that you want to extend it. So I've got to speak to my lawyers to see if there's a calling off period, because I've just extended mine. But if there is a calling off period, as soon as that calling off period comes around, I'm going to be looking to extend mine again. And the cost of the lawyers to extend that is probably going to be cheaper than the lease the ground rent I'm going to pay over the future, or at least I will weigh up the cost difference between that. No money down property investing. So many debates around, is this fact, is this real, can you do it? The answer is yes, you can do it. It's been missold a little bit by some gurus trying to sell you courses, but the reality is you can do no money down. You can't do no money to buy a property, but you can do none of your own money. So if you use collateral, if you've got a property, you can use the collateral in that property for the deposit on your new property. This is a thing that happens all the time. If you lend other people's money, you can use this, and it's none of your own money, so it's no money down. And there's an article in the Daily Mail that is saying a Miami mortgage firm is letting home buyers use cryptocurrency as a collateral for loans so they don't have to make a down payment. So this is basically no money down. A similar article was run in the Forbes and actually had the title of this, no money down crypto property investing, or something along them lines. So this is basically using your cryptos as your collateral. So I see Sam Harris, he's a mortgage broker, UK mortgage broker. Go and check him out, he's a great broker. Heard him talking about this the other day. I can't find anywhere online it says that any UK lenders are doing this, only the Miami one. But Sam Harris might be able to tell you different, because I heard him talking about that the other day. But again, this is another avenue for no money down. Is it a safe avenue? I feel the crypto market is so volatile that, wow, it would leave things a little exposed, but it's just showing the times are changing into this digital space and this understanding of digital markets. There could be a massive shift towards digital markets, digital currencies, especially if we do hit a massive recession at the moment. So keep an eye on the space. And finally, my predictions, what is going to happen to the market? How do you respond to this market? So as I said, look, I'm not an advisor, and for sure, look, when we went into COVID, COVID, I thought we was going to hit a recession then and a property correction then, and we didn't. So none of us know for certain what's going to happen. There is massive signs that we're going to hit some sort of correction and some sort of recession, but there is also signs for inflation still going up and stagflation. So off the back of them signs, my views, and these are just my views by the way, this is not financial advice, but my views are, I feel property prices will just slow down. I think we will still get some moderate growth, but really start to slow down as this really kicks in, as the cost of living kicks in, as the banks get a little bit more concerned, as people get a little bit more concerned more on a psychological level, and the placebo effect this will have over their decisions. I feel this will slow it down, but again, I believe there is such a shortage of inventory that there's still going to be a bit of an upward pressure until that catches up a little bit. But the fact that builders are slowing down as well a little bit, because they're looking at, because if you're building, you're doing long-term strategies, it's very difficult to plan for them. You could start a build today, and if it takes you 2-3 years to get through planning and build this, the prices can be very different. So a lot of builders, big builders, are showing signs of holding off a little bit, which is going to hold more pressure on the property market. So my predictions are, I don't know if Fred Harris is correct and we're going to get all the way to 2026. I believe we could go into a recession, but I believe we can have stagflation and property prices could still inflate, and we should still get inflationary factors going on even while we're in a recession. That's just my view. Not sure if I'll be right, but that's my view. But what can we do around this? What can you do to be able to mitigate this and navigate this? Should you be sitting on your hands? An article that I covered in the All About Property group, which I do live videos in there every week for the group as a speaker for that group, said hang on to your money and wait to buy at the bottom end. Look, if there's nobody who will know this for certain. So what you do to mitigate this is buy assets that are cash flowing assets and strong yielding assets can handle interest rate rises. As I said earlier on, 4.7% is the average for a homeowner on a variable rate. So what you've got to do is stress test this on variable rates. If your property price dips, you come to the end of your fixed term, what would that look like on a variable rate? I just went off a variable rate as a buy to let, and I was at 6.25% on a variable rate. We just took it off. It was just at the end of my fixed term. We got it off at that end of that fixed term, put it on a 5-year fix. So what would this look like? That was when the base rate was at 0.75. So imagine the base rate gets to the 2%, what the bank is targeting to get it to, but to try and slow down this inflation. And can you see why they're doing it? Yes, I can understand why they're doing it. They're thinking, look, if we have a bit of an economic slowdown or downturn, it's much more like they're just playing with fire at the moment. What is the thing that's going to burn the most? Massive inflation or a bit of a downturn, and for them they will happily sacrifice a bit of a downturn to curb inflation, and it's probably the right decision. So you've got to test your property to see if it can handle high interest rates. You've got to test your property to see if they go empty, can you cover the mortgages on these if somebody loses their job and people go into recessions and people lose their job, or their cost of living gets squeezed out? So could this be covered by housing benefits? Are you really maxing out on people's affordability? So some areas like where I live, I'm a remote property investor. That's why I invest in the north, because it's really in line with the cost of living of people. But in the south where I live, so many people are struggling to pay their rents and things like that because it's so stretched. So the money they've got left over is already short. Where people in where I invest in the northeast have got a lot more surplus cash, even though they earn less money, because the cost of living is much lower already. Main cost of the living is being that mortgage. So I believe they can handle a higher inflationary factors on their day-to-day cost of living, because their mortgage cost of living has historically been a lot lower for them. So this leads me into what you can do. I feel you should be buying high yielding, low purchase single let properties, and single let properties are family homes that could be covered by housing benefits. So if somebody did lose their job, it's not too far away from housing benefits payments, so you can ride yourself through this. And the only place you can really buy them, you can't buy them where I live, this is why I invest 250 mile away, is around the north of the England, a little bit in Wales. There's a few pockets, but you definitely can't buy them in and around London. The only deals you can buy in and around London is like bigger development style stuff. So what I advise you not to look at is stuff that's going to take you a long while to develop, because you don't know what the cost of labour is going to be, the cost of materials, the inflationary factors. You don't know what the banks are going to lend like. You can be into a product at the moment on a bridging product, developing it out, going through planning, and then at the end of that, which I'm doing at the moment by the way, but at the end of that, what could happen is the interest rates have changed. You can't exit it as easy. The banks get uncomfortable. A lot of commercial lending as well, they can call recalls. So what I advise you to do is, you're a little bit nervous, unless you've got a good foundation. I've done other videos on this. I'm not going to do a video, go too depth in this now, but build out that good pyramid of foundation with a strong base of single let properties at the bottom, and that support any higher stuff that you've got, because you've got income coming in from them that can handle any shocks in the market. So if you want to learn about that, please DM me on Instagram, ideally, not so much on YouTube, but you can message me on YouTube if you want to learn about that. Please look out for our next up and coming workshop. We've not announced the date on that, but it's how to invest in BRR property remotely and live on your terms. This is recession proof investing. This is stuff that keep you in the market for a long time. So if you want to learn about that, jump on our waiting list for our next workshop. Reach out to me if you want a discovery call. I offer free discovery calls. DM me on Instagram, ideally. That's the place I pick up my messages the quickest. And make sure you're sitting in this residual place. I know it sounds sexy doing these big deals, all money out, and these certain deals, but make sure you do deals that can weather this storm. If you're a little bit further on and you've got a good foundation, you can go for these bigger deals because you've got that foundation to do that. But time in the market will always beat time in the market. So I hope you found that useful. If you're still hanging around to the end, means you did find it useful. So please, my why is to live my terms, my mission to help as many people live on their terms. So please help me out by sharing this, giving this a like, subscribe to the channel to make sure you don't miss any more videos that we release like this. And remember, if you don't evolve your ideas, you'll never live on your own terms. So evolve your ideas, live on your own terms. Have an amazing day.